Katie, welcome. Good to have you with us.
Thanks so much, Tyler.
What tells you that that your short-term outlook ought to be bullish, but longer-term you're cautious? What do the charts tell you?
Yeah, well, in September, we got a very widespread oversold reading, and that happens multiple times, usually in bear market cycles, and sometimes you get a muted reaction. This time, we saw enough improvement in our short-term momentum gauges to suggest we have a relief rally in store that could even rival the relief rally that we saw over the summer months. So our short-term gauges, our indicators do point higher, and we have implications from our overbought, oversold measures for at least several weeks of stabilization. This, of course, comes at a pretty seasonally beneficial time for the markets as well. So that would add to some conviction that October indeed killed the bear market temporarily, at least. But beyond the near term, we do think the bear market will keep its hold.
And one of the reasons you say that is that as you look at the S&P's performance, as I understand it, and when I start talking technicals, you better look out because I'm a dangerous soul here. One of the things, and I do know enough to know this, when you get lower highs and lower lows, as we seem to be getting in the S&P, that is not generally a good sign.
No, and it's a really important point, actually. And while it's somewhat simplistic to trust that lower lows are a bad thing, we saw a lot of lower lows in September. And we have to frame the relief rally within that context, that we do have the long-term downside momentum still negative. It's still very widespread and expanding on the downside. So with all those breakdowns, those dictated bearish bias beyond the near term. So that puts us on the lookout for a loss of short-term upside momentum. While we're not even really sort of inclined to take counter trend positions, we know a lot of people do that anyway. We would be watching very short-term gauges. And as soon as they start to roll, just like they did back at the August high, we'd be pretty quick to reduce exposure again, put on those short-term market hedges and manage risk of the next drawdown, which for the S&P 500, we do think will take us back to 3,500, potentially, early next year. So we want to brace for more of the same. Let's
talk about the dollar and talk me through what you see in its price action in recent weeks and what you infer from that about the broader markets.
Well, I think the dollar is in a very strong long-term uptrend. And within that context, of course, we're seeing some consolidation. I'm just seeing it as consolidation, not any kind of major reversal. And I'd extend the same comment to Treasury yields. We're looking for more of the same sideways, sort of choppy action in the dollar and yields. And that could actually be seen as sort of an impetus here for the relief rally in the equity market in part. Certainly macro forces are really the drivers, it seems, although, of course, we have earnings season at hand as well. So with the dollar poised to consolidate further, we're actually getting some questions now about the emerging markets. Some people are interested in, I guess, bottom fishing, you could call it, in that area. And we think, it's still very high risk to do so, but we could get some temporary relative performance from some international equity markets as the dollar pauses. But we really want to defer to the long-term prevailing trends, which is up for the dollar, up for yields, and down for equities.